Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this webinar today on Spring into Action and Tame Volatility with Straddle Option Spreads. My name is Gina Bocayes, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. And just wanted to briefly go over a few housekeeping matters with you. The session today will last around 1 hour. Our speaker will present for approximately 45 minutes. And when he's done, he'll get to all your questions in the Q&A box. We ask that you look now to locate the Q&A box on your screen. If you have any questions at all during the webinar presentation, please feel free to type them into the Q&A box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And to tell you briefly a bit about eOption, we offer you lots of options for your investing and trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we love and specialize in options trading too. You can also trade in our powerful trading platform or our mobile app, and you'll get over $500 in free trading tools and research if you join us as a customer. We offer you some of the lowest rates in the country, including zero commission on stocks and ETFs, and options are just 10 cents per contract. Our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for over 45 years. He created his ideal trading company that caters to those who have a passion for investing. And at eOption, we support trading education, and we encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. We recently revamped our entire page and have playlists on whatever you're interested in, including new videos to take advantage of earnings season. You can go to youtube.com/eOption and take a moment to subscribe now if you'd like. And if you subscribe, you'll also be notified as soon as a copy of this recording is available. And also make sure to visit our website at www.eoption.com for more trading resources, including lots of videos on there. And we also have clickable strategy links on over 50 option trading strategies. And now I'd like to turn our attention to our speaker now, Teddy Keckstat. Some of you may recognize his name from past webinars he's done with us, and he's one of our most popular speakers. We'd like to welcome him back today. And Teddy is a professional trader and has over 30 years of trading experience. You'll see that he's very passionate about the markets and educating others. He's currently president of Forex Trading Unlocked and the author of the book, High Probable Japanese Candlestick Patterns. And without further ado, I'll turn it over now to Teddy Keckstat. Thank you.
Thank you, Gina, and thank you everyone for showing up today for our webinar, Spring into Action and Tame Volatility with Straddle Option Spreads. All right, so real quick, we want to just get into, let's see, there we go. All right, so we can skip over my little credentials, thanks to Gina. And for all you bulls and bears out there, we're going to just show you our disclaimer real quick to remind you that this webinar is for illustrative and educational purposes only. There's a time lag on everything that we're going over, except for some of the things that I'll be highlighting as we go along. And I always throw up my disclaimer because since I have a company, I always make sure that mine's up there when I do anything like this. All right, so the parts of what we're going to talk about today, we're going to talk about underlying stocks, which are the assets that will have option spreads that we're going to find different positions and how you would adjust the position as time goes on. Call options are the first part of the option spread, and the call option gives you the right to buy an asset at a fixed price. The put options will be the second leg of our strategy, and that gives you the right to sell an asset at a fixed price. Now, as far as whether you're going to be buying or selling any assets, don't worry about that. It has nothing to do with the option spread, and that's all going to become really clear for you as we get into this. This is a very basic spread that can be used by both advanced and beginner traders. It's not something that's only isolated to beginners, and we're going to be talking about the purchasing of these spreads, because that selling the spreads is a totally different thing. It's definitely for more advanced traders, and that is something that with this webinar we're not going to get into. Okay, so the length of time before option expiration is something that we are going to go over. Increasing market volatility is something that we're also going to go over when it comes to dealing with this type of option spread. And the indecisive market direction, that is something that is plagues many traders, and this is a position that you can take that when you don't have a sense of direction, that you can take advantage of moves in the markets by not having any clue as far as direction, but that's just the fact that movement will occur is all you need to make sure that is going on. How to integrate straddle option strategies into your own trading plan is something we're going to go over today. And we're going to kind of show you how to do that by using different technical analysis and fundamental analysis techniques to show you how we arrived at these potential trades. So what is the proper way to manage the options before they expire is something we are also going to cover, and taking advantage of directional options trade setups also. So you don't have to, if maybe you have no clue as to whether the market's going to go up or down, but you're just really keen that volatility is going to increase and that market movement is most likely to occur. So that would be a reason why you put on this type of position. And also, if you do have a directional bias towards something, this is also a type of neutral spread to put on to reduce your risk, actually define your risk for one, and also give you different target levels. So if you are correct on your directional, whether it's a buy signal or a sell signal, and you integrate this spread, this will give you exact target prices for where you have to minimally cover to break even, as well as define your risk. And then obviously, if your targets are right, then that would give you a projection for potential profit as well. Okay, excuse me. So let's explore Fibonacci, trend analysis, order entry, platform execution, and how to monitor trades. So we're going to have 3 examples that we're going to go through during these case studies. And if you have any questions, please make sure to leave them in the chat box, or the question and answer box, excuse me, and we will go over them as we get through this webinar. Okay, so how do you make and lose money? That's what everybody wants to always know first, right? Okay, well, if you were to just buy a stock in the asset or any other asset and the market goes up, well, you profit. Most people are pretty aware of that one. Conversely, if you buy a stock or underlying asset and the market goes down, you lose money. Okay, so that's pretty basic. So if you were just to trade any of these 3 stocks, that would be exactly how you make or lose money. Everybody pretty much has that one down, right? So with the spread, a straddle option spread, what is the difference of putting on a position such as this versus just buying the outright stock or asset? Well, when you buy a straddle option spread, time is your enemy, because whenever you buy options, there's a time value. So for whatever the date is when you purchase an option, up until the date of expiration, that time is always decreasing. So whenever you purchase an option, you are purchasing time as well as other variables in the pricing of an option. So that variable does work against you. So that means that if you purchase an option or an option spread, what have you, that is volatility averse, that means that from the moment you put that trade on, and if the market does not move at all through the whole course, let's say you have a month until expiration and the market just flatlines, no matter what, you're going to have a time value that's decreasing every day. So that's why time is your enemy. Now, volatility, however, is your friend. Now, volatility, if any of you have, unless you have just woken up from a coma, are well aware that volatility is definitely raging in the markets and probably is not going to really slow down for any foreseeable future, especially due to a lot of the geopolitical events, which we're not going to get into any of those things. However, topics such as that definitely impact the market volatility. So that is your friend. So when you are purchasing option spreads, especially, this is a good thing. Okay, so between time and volatility, it's going to be a little teeter-totter effect where one can outpace the other. All right, now the nice thing about these spreads is that your risk is always defined. You cannot lose more than the purchase of the options and your plus your commission and fees, whatever that is, based off of the quantity of option spreads that you put on. Okay, so you break even when your market movement equals the cost of the spread. So from the time you initiate a spread, because you know you're always selling the offer and buying the bid, or excuse me, buying the offer and selling the bid, there's always a little bit of an edge when you put on a position. So if you were just to put on a position instantly now and sell it outright right away simultaneously, you would lose that spread. That's how it works in any market. So it has nothing to do with options. It has to do with how the mechanics of getting in and out of the trade. So your break even, you would need at least some market movement from the time you execute to the time you, or excuse me, when you execute your buy order until the time you execute your sell order to have any type of profit. Otherwise, you would have it instantly, you have the commission cost and what have you. Now, your break even point is set as far as direction. The nice thing is that we're going to go over your maximum break-even point. That's where it has to be for sure at expiration. Now, the thing is that if you hit above your break-even point before expiration, the value of your options will be worth more than they will be at expiration because of the fact that you will still have time value in certain things that will be in place, which is a nice little bonus if you have a move that happens sooner than later. And we're going to go over that as we get into our case study. And lastly, this straddle option spread is a market neutral position. So direction is irrelevant. You're not a bull, you're not a bear. The only thing is you need the market just to move. That is the biggest thing. And so it's not about trying to predict where it goes. You just want it to go somewhere and go away from where you are at the current levels when you enter your trade. All right, with that, let's get into our first case study. So we're going to go over 3 case studies today for our straddle option strategies. And we're going to go through Draftkings, Peloton, and Walgreens. So 3 stocks that I think most of you are pretty much familiar with to some degree between the advertiser, between the ad, for sure, you have to have seen an ad commercial for one of these 3 companies. Okay, so with our first example here, we have Draftkings. So let's take a look at what was going on here when I started figured out this example for Draftkings. So the market, it was trading around 1757, as you can see here in red. This was this last bar here. This is where the market was going. Now, as you can see, the market has been trending lower for months on end, making consecutively lower move highs and lower move lows. Now, as it came into March, it had made a lower move high, and then it made a lower move low in the middle of March here. Okay, now this continued the bearish trend. And as you can see, we got this downward sloping gray line. This is a downward sloping resistance line from the longer term trend. So when that came from all the way back in time off of this last recent low, that had kept this trend intact until it finally started to break out, not necessarily break out to the upside as being bullish, but just by attrition of time, it came through this resistance line. So is that bullish or a buy signal? Not necessarily. This market, you never want to try and pick a bottom or a top. And the fact is the market was continuously making lower move lows and lower move highs. Now we added a little Fibonacci here. And for those of you that don't know what Fibonacci is a mathematical ratio where you have different ratios to find different support and resistance targets, as well as projected targets to the upside and downside as extensions as well. But for simple math, we're going to use 2 levels, which is the 50% and the 0.618, mainly reasoning 50% because that's also it's been a trading target number for traders for a couple hundred years. It's also a Gann analysis number and a couple other mathematical reasons is why 50% as well as the 0.618 or close to it are 2 target objective areas. So from that, we take this last high here and then this last major low here, and we try and find our resistance areas. So our first level is right around this $20 area, and the second one is $21.21. Now, if you notice, this is the 50%, the $20, and then $21.21 is the 0.618. As you can see, as this market, after it had made this low, it started to find this is a little bit of resistance here at the 50% and the 0.618, and it acted on a correction basis. This is a good sign that the trend stays intact. And as you can see, when I started this example, the market had started to fall down and had taken out this last swing low here. So at that point, we know we're kind of at a pivot point and the trend is continuing. So that gives us an idea that, well, if the pricing is right on the options, we don't know for sure if this market is finally neutralizing and going to finally turn the upside, or if it's going to continue to trend lower. So if it continues to trend lower, then we would be looking for lower move lows that would support a nice market break that would give us a reason to believe that the market is not staying where it is at. So I took a look at the different options, and I looked at the $18 strike price. Okay, so the $18 strike price was a good level because it was just above where the market was trading. Now for a straddle, when you buy a straddle, you purchase one call and one put of the same expiration date. Okay, so as you can see, this line here, this is our $18 strike level. Okay, so it's the same level for both the put and the call. And the expiration is also the same. We picked May 13th as an expiration. Typically, when it comes to straddles, and you want to use around somewhere between at least around 30 days to around 45 days if you're looking to take advantage of a decent market move situation. Okay, so and especially right now with the volatility that we have in place and the fact that this particular example has been trending lower. I mean, just 4 or 5 months ago, it was trading at almost 3 times the value of where it's at right now. So that right there means that either the trend is that severe and you still have room to the downside, or if you have any type of consolidation and pullback, you should have at least a decent chance of getting a nice leg up, if you will, for any type of correction, which would help a position such as this. Okay, so now if we choose this $18 strike price and use the put and call for this example, that would give you a pricing action of $3.96 or $396. The $18 put costs $2.17. Now everything with options you multiply by 100. So that would be $217. And then the $18 call, which is $1.79, would be $179, totaling $396 plus your commissions and what have you. So once again, we have a bearish market here. We noticed that on a corrective level off of this last swing low, it came into our Fibonacci numbers, which means resistance seems to be the call, that this is where we have a new lower move high. Okay, so I didn't put a new H here because at this time we didn't know, is the market going to break out to the upside or break out to the downside? You know, that was the big question at that point. Okay, now since then, the market is actually trading a couple dollars lower at $15.97. So right now the market is lower than it was back then. Irony of it all is, though, it did trade up higher. It traded above the $20 mark, actually. So, okay, so we don't know that right now in this situation, on this date, we were looking for the market to move. So we put on a put and a call of the same strike price. So when you enter this on the e-option platform, it's very, very simple. You put in your symbol here for your option ticket. You can see where it says symbol, you put in Draftkings. Now, the major thing is where it says true strategy. This is where you want to hit straddle. The reason being because it will give you 2 options here to put in here. And now both of these, because we're buying this option spread, it is a buy to open order. So the first thing is under action, you put buy to open, because no matter what, both of these options you want to be buying. You don't want to be selling one of these, because if you do, that's a totally different type of position. And selling options, unless you know what you're doing with this, even a spread, it's not for beginner traders, that's for sure. Then it comes to quantity. You always want to make sure that you have the same quantity of both calls and puts to make sure that the spread is, well, it's a spread. You have to have one of each on leg. If not, then you would be open. You would have an outright option. So that's something you want to always double check. And then your expiration date too. In order for this to be a straddle, you have to have one, the same strike price. And then number 2, you have the same expiration date. Okay, so May 13th is what we chose. You can see here we have the strike price of $18. And then here we have the call. And on the bottom, we have the put. And at the time of this order entry, it gave you both the bid and the ask for both options, telling you exactly what the market bid and market ask debit would be. Okay, and then after that, once you hit the let's do this, it gives you the option of to finalize this option order. because it shows you once again buy to open one contract, Draftkings with the expiration date and also the strike price, call, and the same thing for the put. You can see that it all matches up. It gives you the price of the trade plus your OCC fee and ORF fees, but those are mandatory no matter what. So your total cost gives you the value of that. And then after you hit the trade, you confirm that, it gets executed, and then it confirms the cost. So for this position here, to buy the put and the call for the $18 strike price with an expiration date of May 13th, 2022, the total cost was $401.32. Okay, so it was $397 for the option. And then there was with the commission, that was the balance there. Okay, so after that, you know a couple of things. One, you know that you are in the market, and number two, you know exactly what your risk is. Okay, so you are defined completely on that cost basis no matter what. So at the worst case scenario is that you would be if the market didn't move anywhere on expiration and literally flatline, the most that you could lose on expiration if you let them expire worthless would be that $401, or basically $397 for the options trade. Now, what was the break-even cost? Remember when we had those slides? We'll go back to our chart real quick to show you where we need to be today or by expiration. So the blue lines we have here at 21.54 and 13.62 here, this is our break even. So if it costs $396 from where we were at, and on expiration, very last day of expiration, the price of the stock either has to be above this 21.54 or excuse me, at 21.54 or higher, or below at 31 or 13.62 or lower to be at break even. Okay, so at that price, that means that if the market settles and on one of those two numbers or higher or below it, you will have a break even or a profit on this straddle. Okay, now if the market goes above your break even upside break even point before expiration, then you would have actually a premium. That's when you start to build up. So no matter what, let's say that the market settled $5 or went $5 above your upside break even point. At that point, you would have all the money for the cost of your spread initially, plus a profit of anything above that. So that's where you basically could look at it as being long from that point. Okay, so that's how you have extra profit built into your option spread. So now that's, remember, you have to pass your break even though to see that value. If you fall below that expiration or the break even point, whether it's the upside or just above it to the downside, you can still have some value in your options because remember, you have both a put and a call, but you're not going to recoup all of it. So it doesn't mean you're going to lose all of your money on expiration, or if you get out before expiration, let's say the market's been flatlining, there's only a day or two left and you're like, okay, well, the market's already, at least the stock has moved, let's say $3 or $4, and you have some premium on either the call or the put, you may want to just cut your losses and take back your money, and at least you definitely won't lose the full $396. You may only lose $100 or maybe even less, or maybe $200 depending on how much the stock moves. But at least you can take advantage of that ability to change your mind on the trade. So you still have some, if the market does move, because you're playing both the sides, because you have a call and a put, the market just has to move. The only thing that can really hurt you with this whole strategy is that if the stock does not move at all. If it stays at the same price, if the market price of the underlying asset, the stock, what have you, stays at that same price, like in this example, Draftkings was $15.97. So today, excuse me, it was $17.57. So today the market was trading just below $16. So there's $1.57 or a little over $1.50 already of direction where the put gained in value. Okay, so you lost on the call, but you gained on the put. So no matter what, at least there you retained some value. So let's say the expiration was today, you would be able to get out of this trade with still some money on the table. It wouldn't be zero because you would have whenever the market moves, you're going to gain on one of those positions. But in order for that one put or call to cover the cost of both options. That's why you have your upside and downside break even level, because the stock has to go above or below those by expiration. Otherwise, you won't be able to recoup all of your initial investment. So this will become more clear as we get into the next example. And also, before we get into it, let's show you where Draftkings is now. You can see that Draftkings has, like I said, it was just below $16. And the cost of the spread now was $342. So the market had moved just over $1.50, and the spread itself had only lost value of $50. Now, remember, we talked about time decay. So the market did move. So we have an increase in value on the puts. The call decreased in value because of the market movement, but time also eroded both options. Okay, so you did have a little bit of time decay. So the cost of the spread is a little bit less now, but there's also less time. Remember, you pay for time when it comes to options. However, you still have over 3 weeks left until expiration, and you already have a nice move to the downside. And considering the trend is your friend, this market continues to want to make new lows. Most likely over the next few weeks, you might see new lows, giving you a chance to see the lower break even, or even see a profit where it goes below the break even target price. Okay, so now let's go to Peloton. Okay, so let's see. Let's make things clear. We'll make this a little more clear as we get through these examples. So once again, we have a market that was trending lower. We had been making lower move highs, lower move lows, lower move highs. And then all of a sudden we're looking to see, is this market going to make a lower move low? So in this example, we do the same thing. Remember, a straddle is where you buy one call and one put of the same strike price and the same expiration. In this case, we're going to choose the $25 strike price. Why? Because the market's at $24.63. It was right there, right in the middle of that spread. Okay, so once again, we use the May 13th expiration. Okay, so with that, we have $24.63 is where the market is at. The cost of the put is $3.30 or $330. The $25 call, or $25 strike price call, is $3, which is $300, for a total of $630. Now, with that, that gives us our break-even points here of 3102 in black and blue here, and 1842. Now, interesting about this 3102 is, remember how we used Fibonacci as far as trying to find resistance in the last example? So we had this downward trending market once again. So we'll use this last previous high right here. Then we use this low right here. And then that gives us our Fibonacci retracement here, which this lower line here, right around $30.11. This is our 50% line. And then we have a 0.618 line, which is this 3248. So this here, in this target range here, you could see where the market made a high, fell just short of this 0.618 line. But in between this 0.618 and this 0.50%, this is our break-even target. So this is pretty interesting. So let's say that we put this position on right here, not knowing whether the market is going to continue its bearish trend or if it's going to reverse gears and start an upside correction. We do know that the market had already topped out and found resistance here at this 0.618 level, 50% area, basically. Okay. And then it came off of it to where it was trading at this situation here. If the market goes back up and challenges resistance, our break-even point is right inside this area. So you would expect that if the market was changing direction, you would accelerate the move to the upside, which means that Peloton would have a good chance of yielding a profit to the upside on this straddle position. Conversely, if the trend remains intact and this resistance holds, that means this is a lower swing high, setting us up for what? A lower swing low. Because remember, trends go in higher move high, higher move low in a bull trend, or lower move high, lower move lows in a bearish trend. So if the bearish trend continues, it would make sense that this last low, which is just above our break-even point, we would test that. And if we fell through that, we would probably give us a nice little bit of profit to the downside below this break-even point of 1842. Okay, so this is how we find our break-even points, remember, and also double check to see whether or not we'd like this scenario of whether the trend will stay intact or whether it has a chance of reversing. This is a nice situation, just like the last one, where the market is harmonically bouncing off of these resistance areas, maintaining the trend, meaning that we know that the market is not consolidating. That's the one part where, remember, where we can run into an issue when it comes to the straddle, because time value is always ticking away from the time you put on the option to the time you either get out of it or it expires. That is always decreasing. So you need volatility, because volatility it adds premium to your option cost. And volatility also helps to gain momentum in direction, meaning that the market is less likely to stay static. Okay, so remember, we don't want the market to stay still. We don't want it to go sideways. And the nice thing is about both these examples so far, they were in bearish trends. So typically a market continues its trend or it reverses its trend, and it takes a while before it goes into a sideways trend. So most likely this type of position, the strategy, even though it's a very basic one, these are both two scenarios where it holds up, and it's a good option, if you will, no pun intended, to trade these different stocks, especially because if you were trading the Draftkings or even this Peloton here, if you were going to buy 100 shares of stock to be long the stock and be bullish, well, that would be trading against the trend, which is, I would never say try and pick a bottom, and that's the nice thing about this is you don't have to be right on direction, and think about this. If you bought the stock and it does continue the bear trend, well, it's going to go down in value. So you may own the stock, but it's just going to continue to erode in value. The good thing is with this is that where your risk is at. Your risk is $630 for this position here. So we have a couple of questions. We're going to get to those in just a little bit. We're going to get through this example and one more, and then we'll get to them. Very good questions, by the way. We're going to integrate those when we get through these. Okay, so we found, once again, our initial strike price, and we found our break-even points. Okay, now at the time, just before this webinar, Peloton was trading 22.15. So this market is actually $2 lower. So it's kind of halfway towards the lower break-even point. The nice thing about it is it's also getting closer to this last lower move low. Okay, so for Peloton to be where it's at, that is a very good indication that this straddle has yet a little potential to the downside. And remember, there's still 3 weeks left in this trade. Okay, so let's see how this would have worked out. So remember, once again, on your option ticket, when you go into your trading thing, you can see from the platform that there's a trading area. You hit that button, it pulls up here. You can have your stocks, but in this case, we're using the option ticket. You put in your PTON, which is your Peloton symbol. And then also you put in your choose strategy, which is a straddle in this case, and that would give you two options right off the bat. And then you double check to make sure that you are buying to open, because you are buying the straddle, you're not selling the straddle, and your quantity, which is 1 in this case. And then very key is the fact that besides that you're buying both of them is the expiration. You have to have the same expiration date. If you had different expiration dates, it wouldn't be a straddle, it would be something totally different, which we're not going to get into because that's a more advanced play. And then we have to make sure that the strike price also of $25 is the same for both options. And then we get to here, you want to make sure you have one call and one put. That's where you have the difference. It gives you your pricing for both of these, and it gives you your price for both the debt for the bid and the ask for these positions. Then once you put it in the trade to confirm it, it lines it up. It gives you the cost per trade and the estimated cost before execution. Once again, you hit the trade to confirm it. It gives you your confirmation status, in which case it tells you your account number, and it says your buy to open, your one contract of Peloton, May 13th expiration of $25 strike price call, as well as the put. And then you have your confirmed price, your total cost. So this allows you to know that your break even is where it was at, where we set it, and you don't have to worry about risking any more than that. The worst case scenario would be that you would lose $634 should the market go absolutely nowhere. And even if the market was to go like it is now, it's already moved $2, you would have on the put side an increase in value on that option, although you would have a decrease in value on the call, but you would have that momentum. So no matter what, you're not losing value if the market moves. As long as the market moves, you are holding some value in your position. And if you get As long as at expiration you are at break even or past it, you will be profitable or at even. And remember, you could be right in front of the break even, and especially if you have a lot of time value left, you could already be at a profit. So remember, it's only at expiration that it has to be that high. That is the least the market has to move in order for you to clear break even, and then know where your profit level goes from there. Okay, so once you execute, it shows in the platform, as you can see here, it shows the Peloton, it shows your where you put the market value of your options. It already shows our Draftkings position here, where that already has a little bit of market movement. It shows your quantities here, and it also tells you the last where the market had traded. So at this point, you know that you now have 2 spreads that we have put on, both one in Draftkings, one in Peloton. We have everything is defined, and we can see exactly how the P&L is working from there. And just to remind you, Peloton right now is down a couple dollars. So the cost of the spread initially was just over $630. And right now the cost to get out of it would be $577. So it's only down around $60, but it has $3, or excuse me, 3 weeks, a little over 3 weeks left before expiration. And it only needs a little bit of market movement to actually get to the break-even price. Because remember, we had a break-even price to downside of 1842 for this trade, and right now it's at 22.15. So it's only got another less than $2 to go, and it's at the break-even point. And the way this market's trending lower, I would say going into earnings season, there's a good chance of actually seeing that. So as you can see, this example was done a few weeks ago. There hasn't been much of an erosion on the value of these spreads. So they've been on with a chance for anything can happen with this market volatility for market movement. And we still have a little over 3.5 weeks left to go for both of these. All right, let's get into our, as you can see here, I wanted to show you where the current spreads were, so that you can see the price of where we were at with Peloton, and it shows you once again that we are right around the 577 for value at the time of today, just before the webinar. All right, so we're going to go through Walgreens, and then we're going to get to our questions. All right, so this one is another market where the market has been trending lower, making lower move lows, lower move highs. And interestingly enough, we got a lot going on here, right? So we have a gap here in this market. So we came off this low right here in February, caught a nice little rally, made this lower move high, found resistance, and then boom, the market's been trading lower for Walgreens ever since. It's kind of funny. You would think that with the way everything's worked for them the past couple of years, that Walgreens would be doing much better, but it isn't. What's financial is the profit margins actually took a dive for a year, which I don't know how that was possible. But anyhow, we have this gap. Now, the reason I have this circled is that when you have a gap, typically gaps get filled. Now, does that mean just because you have a gap here, the market has to go and fill it right away? Absolutely not. But that does give us an area to look for that the market may gravitate back to. Interestingly enough, when I was working on this example, I noticed that the low was 2 days prior, and this was actually a high probable Japanese candlestick pattern, buy pattern that was forming. So after I'd seen how the previous day had settled positive, like this little node right here, and the low had stayed intact, and then seeing how the market was following through, I'm like, well, this is a good indication that the market may not have necessarily bottomed for the longer term, but in the short term, a correction to the upside is very likely with some upside follow through, especially if the market settled around this 44.08 that on that day or around that day. Ironically, it actually did trade higher, and right now is trading at 46.63, which will get us into this area here. So interestingly enough, when this pattern had been forming, I figured, well, let's take a look at the strike prices here. So the market was trading at 44.08. So we have a $45 strike price available with the March 13th expiration. So I'm thinking here, the market has been trending lower, as you can see. It bottomed here in February, started to rally up into mid-March, hit resistance, made this lower move high, and then we started to slide. For whatever reason, it had this big slide here, going into April, and had made a lower move low a couple days prior. So for all intents and purposes, this was a bear. I'm thinking, well, if the bearish trend continues, no matter what, not a bad time to put on a straddle. And if we do get a correction off of this buy signal, an even better time to buy a straddle. So this is where you can use direction as a reason to put on a position like this. And think about this. This market has been trending lower. It's in a bear market. Why would you just go out and buy the stock? It would cost you $4,200, over $4,400 to buy the stock when you could buy the option for $326 for the spread. And now obviously there's a little difference in your bang for the buck, one versus the other. But the outlay obviously there's a huge difference in that. Now also, think about this. This is a counter trend trade if you are bullish. If you're going to go, remember this market's been trending lower as we've been making lower move lows, lower move high, lower move lows. You get it. That's a bearish market. So if you're going to buy the stock, you got to remember anytime you're going counter trend, the trend is your friend. It's not just an old adage that just sounds nice. It actually is true. So, and it's something you need to be aware of, especially if you're trading counter trend, especially with risk. And the good thing about this is that putting on a straddle here is, you know, that you're risking the lows here. Now, if you bought the stock for $4,400 and all of a sudden it drops down below $4,200 where you're losing money, and also you're on the wrong side because you're trying to catch a falling knife. So you deserve to take a little hit there. Okay. And guess what? Until the market goes higher, you are in a loss that you have to either sit on or absorb even more. So then it's a totally different question of what you do. In this case, with the straddle option, if this market was to fall apart, instead of getting an upside correction, if the momentum is that strong, well, that's wonderful, because new lows means that straddle would all of a sudden make new lows and also come to our break even point. Because the nice thing about this is, at the time of looking at the $45 strike price put and calls, the price was $218 for a put, meaning $218, and $108 for a call, meaning $108 for a total of $326. So $326 would be your risk on a potential trade where you have a buy signal, counter trend signal, that you do have this gap that needs to be filled. And when we use our Fibonacci, we have our 50% comes right here at 45.98, and our 0.618 comes at 46.62. And our break even for this trade on the straddle is 47.15. Now, as of today, before this webinar, the market was trading 46.63. That's just above our 0.618, folks. That's more than halfway through this gap. Remember, I said all gaps get filled. It came all the way to our upside target already as far as an upside correction. So this is a good one right here. All right, now let's see how this works out. So once again, with your order ticket, you have WBA, which stands for Walgreens. You have the choose your strategy. Make sure you hit straddle for this type of situation. Then you have two options laid out. You have buy to open for both of them. You have the same quantity for both of them, the same expiration for both of them. And then once again, the same $45 strike price. One is marked call, one is marked put. It gives you the debit and the ask price totals. You hit the confirm for trade. It gives you once more a showing of your estimated cost for this, at 326, coming out to 398 altogether with everything. And here once again, you hit your trade confirmation, and then it locks you in and says where you got filled. And it shows you bought to open one contract of Walgreens, May 13th, 2022 at 45 call, and also a 45 put, and it confirms your pricing and your total risk. So 330.32 is the total risk. Then it shows on your platform your quantities, and there you are, and it shows where your average opening price was, as well as the market value. Now, at the time, just before this webinar, the market value for this spread was 379. So remember, our break-even point is 47.15 to the upside. We're at 46.63. We're less than 50 cents away. Now, if you take that 50 cents on top of that 279, that totally already gets above your break-even point, which means that once you hit the break-even level, you won't just cover the cost of your spread, you will be at a profit. So we have that nice little upside correction working with the Walgreens example. Now remember, we still have 3 weeks away to go. So if you were trading any of these three examples, you could either get out at a minor loss, or in this case, you have definitely Peloton and Walgreens, one moving to the downside, and now Walgreens having an upside correction forming and hitting key levels. It already hit our key objectives to the upside as far as if you were to just have put a call on, instead of buying the stock and you just bought a call because you didn't want to risk that much money, that's a whole $4,500, you would be up, obviously, because you just had a call, you'd be up pretty nicely because you'd already have $2 into it. So, but in this situation, you're covered on both ends because it's all about not knowing or caring about direction. All we care about is that volatility hopefully is there or increases and that the market moves. Okay, so with that, now let's get to our questions and answers here. Okay, we have some nice questions going on here. All right, I thought a call meant to buy and a put meant to sell. So how do you buy a sell? Okay, so really quickly, a call means the right to buy a stock or underlying asset. A put means a right to sell. So if you just buy a call, that means that you are basically long the market. You don't own the stock, but you synthetically control the potential to buy 100 shares of a stock at whatever that strike price is. Conversely, to a put, it means to sell. So, okay, so when it says here, how do you buy a sell? I don't know what you mean there, but when you buy both a put and a call, that means that you're indifferent. You're playing both sides of the market. And for this situation, that's why we have our break-even price, because you know that if you buy a call and the market goes down, well, then you're just losing money. And if you buy a put and the market goes up, then you're just losing money. So in this case, whether the market goes up or down, one of your options will be making money, one will be losing money. The question is how far does it need to go? And that's the whole thing, is that when it comes to this, you don't care whether the market goes up or if the market goes down. You just care that it goes, and then it goes far enough to yield enough money to cover the cost of your spread, plus some to give you a profit. So that's why we figure out your break even, which your break even is lower when you still have time value left. So for instance, like the break even points I put in there, that's for at expiration. By expiration, it has to get at that price to the upside or to the downside for you to recoup, to have a value of, in this case, if it's the upside break even, your call has to equal the price of the original call price plus the put price when you purchase the spread. And conversely, if it's a downside break even point, your put value at that point of expiration has to equal the price of the put originally plus the price of the call, and that gives you your break even. So that means you don't lose any money no matter what. If the market goes above or below those break even points at expiration, that's where your profit, you have that as a profit no matter what locked in. If you have, let's say, a week or two left till expiration, and let's say the market goes $5 above your break even point to the upside or $5 below to the downside, you have $5 of profit plus your break even, you can get out of your trade there, and you'll actually have a little extra money because of the fact that, let's say there's still another week and a half of time value, there would be a little bit of premium there. Now, when you only have like a week or so left, or a couple of days especially, there's not much left in time premium. So I hope that answers your question on that one. How do you determine your break even? Okay, your break even, once again, is your total cost. So that's why, once again, when it comes to this strategy, we don't care about which direction it goes. We just care that it goes. We just don't want it to stay in the same place. So this is the one problem with this strategy, is that if all of a sudden you put on a straddle position and the market goes sideways, all of a sudden stays in like a $1-2 range for the next like 30 to 45 days, which can happen. Markets do dry up right now under current situations. And that's why we mentioned the volatility factor. Right now, we know that volatility as a whole in the market is not going down for any foreseeable future. It's at least the next 3 to 6 months. I mean, even if there was let's say there was a resolution and peace all of a sudden in the Ukraine with Russia today, let's say it was announced and there was a pullback, it would still take at least 3 to 6 months for the market volatility to even start to subside, just because of those reasons alone, not even playing all the inflation and everything else that's going on in the world. So that's why one of these reasons I wanted to do this strategy when I presented it to Gina was that this is a great time for, it's not just for beginners, advanced traders as well. Like we are living in an environment right now that it's very proactively a situation for traders to use straddles and as a means to take opportunity or take out profits from the market and reduce their risks, because there are lots of crazy swings going on right now. And the nice thing is that no matter what, the market's not sitting where it's at. It's just not on any given day or week. We're seeing volatility, we're seeing motion. Now you have to take advantage of that. And that's the nice thing, is that these are 30 to 45 day positions that you put on, so that sometime between the time you execute it and then you have that time frame to get out of it or for it to expire, typically you're going to see that type of movement. So the break even is something you don't have to wait until the last day of expiration to get out of a trade. If the market moves beyond it or below the lower break even, that's how you manage your trade. You already know that you're up a profit once you've covered your break even, especially your expiration break even point. You know that you're in a profit. That's why you put the trade on, and that's when you get out of it. So that's the nice thing about this strategy, is that you can instead of putting on a stock where then the market has to go up, not to mention the capital outlay, like we mentioned for which was it for Walgreens, instead of putting up $4,400 to buy 100 shares of stock, you can put up the $326 to control whether the market goes up or down, a chance to make a profit. And especially in this situation, it had been in a bear market, but we had some reasons why the market may see an upside correction. There was the gap, there was the Fibonacci situation where that had already come into play. So there's reasons why you wouldn't do this type of thing. Like, for instance, let's say we didn't have the Federal Reserve, where we know that they're raising interest rates for the rest of the year every time they meet. That's another reason why volatility is not dropping. So if we had, for instance, if it was 4 years ago when we were waiting on the Fed and they're talking, we don't know, well, we got to wait 2 months or two meetings or 3 meetings that are going to maybe or maybe not cut rates or raise rates. Well, that volatility decreases until they actually do something. Right now, we know that one, they are doing something and there is more to come. So that means volatility is a great reason for option spreads such as this. This is why the reason when I first started the webinar, I was giving you the key points. Time is your enemy, because the time value on any option that you purchase is always decreasing day by day, even if the trade is going in your favor as far as market direction. The nice thing about this is, because it's a neutral spread, it doesn't care about direction. All it cares is that it moves, because volatility is our friend. Remember I said time is our enemy, volatility is our friend. So right now we live in an environment where volatility is giving us a reason to put on these strategy. Okay, so let's see. I'm a brand new beginner. I don't understand anything to predators say. It is for beginners. So I guess maybe we for you need to have a little bit more of a go over some basic definitions. Sorry about that one. Let's see. If Draftkings kept going down, should I close the call side? Okay, no. Here's the thing: is when you put on, this is a very good question. Do not trade out of the leg. That's not the hope. That's a totally different type of thing. That's not what we're looking to do here. When it comes to a straddle, you're looking for the market to go. So for instance, here, Draftkings, yes, it continues to go down. Should you close the call side? Absolutely not, because that's where you're covered. I mean, the thing is, the Draftkings trade, at first it rallied when I put this position on before it actually came down to make new lows. So it actually gave you an opportunity to the upside. Now think about if you would have kept the call at that point and got rid of the put. Well, now you would be down money on the call and you wouldn't have made any, and you would have lost money on the put. So you're not trying to trade one way or the other, thinking that, the market's going one way, so I'll just get out of the side that's losing. That's not the point. That's why you have your break even points. And when you use a straddle, you're expecting the fact that where those break even targets are, whether it's with the trend or a counter trend trade, like we had in a couple of these examples, that if you have a reason for it to move to those target points, that gives you, your break even is below or in those points, that's where you already know you're on the right side. And if you're wrong about direction, the beautiful thing is you're covered. So you never know what comes into the marketplace. Like, look at what happened with Peloton. You know, they were rocking and rolling during the pandemic. Then they started to take a total dive because supply chains and whatever. Then Amazon in one day comes out and says, we're going to partner with you and whatever. Well, if you had a straddle on at that point, at one point, I mean, you would have seen a nice move to the upside. And if you were long the stock, you would have seen a nice move to the upside. With the stock, you probably would have held it. I doubt you would have taken a profit because you would have been like, oh, Amazon's really helping us here. Well, with the straddle, you would have made your profit and then either put on another move or another type of position. Or guess what? It only took a couple of days for that market to go up. And then it took a couple of days for the reaction to be like, okay, that's great. Amazon's partnering with us now, new lows, and Peloton is falling through the floor again. So that's why you don't try and adjust the legs. You keep it on, and then you either get to a certain price movement above your break even point, or even beforehand. So like, for instance, let's say 2 days after I had put this position on, it rocketed up to right below the break even point to the upside, or just above the break even to the downside. The position would be up. Sometimes volatility, if you get a market move that happens very, very quickly and volatility really starts screaming, sometimes the premium is so rich, you don't need to wait to take your money. I mean, the whole reason you put these positions on is to make money. So you don't need to get greedy. You need to see them get to a certain value. And when they do, that's when you take your profits, you know? So in this case, when you have time and you have if you have a price objective that's above, obviously, or below your break-even points, depending on which side, once you hit those points, that's when you get out. Or once you start to get close, that's when you think about taking off the spread, you know, and that's when you have to think about how much time is left. Like, for instance, if you only have 2 days left and you pretty much reached your target objective, get out of the trade. There's no reason to, your time value is almost completely decayed. It's gone. So there's no really any value there that's going to go against you. However, if the market starts to pull back towards its original price when you put the spread on, then you would be eroding a lot of your profits very quickly. So, and that's how you manage these positions, is that it's not that you're shooting for at expiration for it to be way above where it started or way below where it started, is that between the time you execute that 30 to 45 days out, you should have some opportunity with market volatility and fluctuation to take advantage of a nice profit. That's why it's a neutral trade. You don't care about direction. Good question, though. Let's see. Is it possible to chart the fib levels on the e-option platform, or do we have another chart? That's something on how to use their charting platform and how to execute the fib levels. They can help you out with. Let's see, and let's see, do you need to sell them together? If you can clearly see the new direction, can you sell one leg? Okay, so here we go once again. When you get rid of the spread, now here's the thing, is it's a very good question. Do you need to sell them together? If there's still value in the whatever, you're going to make, no matter what, on one leg is where you're making your money, the other leg you're going to be losing your money. If there's still some value in the other leg when you take off the, like, let's say you want to get out of the spread, my suggestion is just to empty off the spread, even if it's just a couple bucks left in the one, because odds are, unless you have an extreme movement going the other direction in that favor, which typically is next to never, it's like a lottery ticket at that point, you know, but I still look at it as like lottery tickets. You're throwing away money over the long haul. So I would say, yes, get out of both legs. Don't keep one on. Now, for instance, let's say that here would be a situation where I'd say maybe you leave one leg on. Like, for instance, you had Walgreens here where we had a reason to buy it because of the gap and because of the buy signal. And then we had that nice corrective area. Once it reached that corrective area right there, and now it's near that break-even point, if it follows through the upside and you want to just get out of the call, because let's say there's still, let's say there's 3.5 weeks left, whatever, and you think the market's going to pull back significantly, like maybe back to where it started to at $44 or even below that, maybe towards the break-even point of 42, where you had a downside when you had the spread. Like, let's say you had a sell signal, like, for instance, we're in Walgreens, and might as well, since we're covering this real quick, we got one last minute. Okay, yeah, I would say that if you still had like another week and a half left to go on it, and you had a sell signal that came in at the time when you're getting out of the spread, like right now, then I would say, yeah, why not? Why not leave the put on? Because at this point, you've already been beaten up on it. There's not much value left in it, and you do have some potential to recoup it over if the market does slide. So yeah, that's a good question. But as a whole, I would not hold on to one leg. It would only be if you had, like, for instance, you're getting out of the one leg because you had a reversal sell signal in that case. But that's typically rare. So, and it's also a bit more of an advanced way to go about things. I would rather use in this case where there was Walgreens with a buy signal, good. And it's also in a bear market, it's a counter trend trade. So if you're wrong, the nice thing is a position like this, if you're wrong, you're going to make money. And if you're right, you're going to make money most likely. So good questions though. Very good. And how do you close the options? Well, then you just go back into your trading platform and you hit, you can close all orders for that one for the spread. Or you can do them individually if that's what you want to do. For like the one question was just asked. What is the ideal VIX level to do the straddle option? The higher the VIX level, here's the good thing is if the VIX is rising, that is a great time to buy into it. Once the VIX level starts, if you see the VIX level is dropping, especially if you have, depending on how much time you have, that's a little bit more of an advanced question on how to manage it. Very good question though. Using the VIX is a great way of gauging when you might want to get out of a trade, because if you see, remember, volatility is your friend. If you see it, the VIX really getting ready to start to drop off, or it does drop off, that's going to start to dampen your potential profits on your position in this case for a straddle. So yeah, very good question about the VIX. Yeah, VIX going up is good for you. VIX going down is bad for you. So that could help nudge you one way or the other of getting in and out. So, okay, we hit the 2 o'clock mark. Great questions, guys. I am now going to hand this over to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative, and you gave some great strategies on dealing with its current volatile environment. So thank you. And thanks to all our attendees today for taking the time out of your busy day to join us and your excellent questions. We know there were a lot of questions today, so if you have any more questions, we're happy to answer them for you. Feel free to send us an email at support@eoption.com, and our specialists will be happy to answer if you have any additional questions. And just a few reminders before you go. On the screen, just want to remind you, we offer some of the lowest commission rates in the country. It's just $0 for unlimited stock and ETF trades, and options are just 10 cents per contract. And we hope you'll visit us at www.eoption.com. We have our videos on there as well as option strategy resources. You can also learn more about eOption. We've been around, our parent company, Regal Securities, has been around for over 45 years. So we've been servicing investors, and we'd love for you to learn more about us. And then also the last point, we hope you'll subscribe to our YouTube channel at www.youtube.com/eoption. And we know some of the questions, there were some beginners on this who attended this webinar as well as advanced traders. So if you subscribe to our YouTube channel, we have about 70 videos. We recently revamped it, and you'll see playlists for no matter what level you're at. So if you're a beginner, you can check out the playlist to start learning more about the terminology and options trading. Or if you're more advanced, we have playlists on spreads, on how to trade earnings season. So whatever you're interested in with option trading, we encourage you to go to our YouTube channel and check it out. And if you don't, we know we have some of our existing customers on this webinar, but if you don't have an account with us, we will be having a special promotion on YouTube. So if you go to this video, it'll be available tomorrow on YouTube, and you read the description, there will be a special promotion that will be up for about a week where you'll get some free stock if you open an account with us. So we encourage you to check that out in the next couple of days so you don't miss out. And we also, one of the reasons I also wanted to point out quickly, one of the points that sets eOption apart from other firms is our trading tools. So if you're a customer, you get over $500 of free trading tools annually to help you with your trades. And one of our best ones is called Options Play. So what it is it scans thousands of stocks daily and highlights potential option trades for you. So we call it demystifying option trading. So that is free to you if you're a customer. And so that's one of the great benefits of eOption, as well as our mobile app. And we have a new stock screener that we have available. We have free research. You get unlimited research reports. So we hope you'll visit eoption.com and check us out to learn a little bit more about us. So thank you again for your time and for attending our webinar. We greatly appreciate it, and we hope you have a wonderful afternoon. Bye now.